The FICO score the mortgage underwriter pulled said 714. The number on the banking app said 760. Same credit file, same day, 46 points apart. That gap, 46 points between the number being watched and the number being used, changed the pricing on a 30-year loan. The total additional cost of that single discrepancy, more than $14,000 in interest that didn't have to be paid. One score was being watched. The other was being used. Only one of them determined the rate on that loan. Nobody explained which was which. You check your credit score, maybe through your bank's app, a free monitoring site, or a service that sends alerts when something changes. You track that number. You watch it move. You feel a measured sense of where you stand. The lender doesn't see that number. The gap exists because 49 versions of your score exist. Lenders pick which one to pull. You've been monitoring one. Right now, depending on what you're about to apply for, there's a real chance the score being used to price your loan is 20, 30, sometimes 40 plus points away from the one you've been protecting. On a $300,000 home loan, a gap that pushes you into a different rate tier costs between $12,000 and $18,000 in additional interest over 30 years. Not projected. Already locked in before you signed anything. The FICO scoring system wasn't designed to give you one universal number. It was designed to give lenders a specific FICO score version for what they're lending for. There are 49 of those versions. You've been watching one. By the end of this, you'll know exactly which version applies to which loan, how to access it before the application starts, and how to close the gap while there's still time to do something about it. But first, there is a newer scoring model some lenders are already moving to. It doesn't look at your balance on one day. It tracks your balance behavior over 24 consecutive months. It can detect patterns the older models completely missed. That part is coming. Let's start with why the number is 49. Credit scoring isn't a single formula. FICO has been releasing updated base models since 1989. FICO 8 is currently the most widely used for general lending. FICO 9 changed how medical debt is weighted. FICO 10 and 10T are the most current generation. Each base model exists separately across all three credit bureaus, Experian, Equifax, TransUnion, because each bureau runs its own calibrated version. That's more than 24 calculations before a single industry-specific version is counted. Each additional model exists because lenders paid for more specific default prediction. The more precise their lens, the wider the potential gap. Every point of specificity carries a dollar cost. The $6,800 on that auto loan wasn't from bad credit. It was from the wrong model. FICO also built parallel scoring systems for specific asset classes. The FICO Auto Score in versions 2, 4, 5, 8, and 9 was designed to predict default probability specifically on vehicle loans. It reads installment debt history differently than the base model and treats past auto-related delinquencies more severely. The FICO bank card score operates the same way for credit card issuers, its own versions, its own weighting logic, designed to isolate revolving behavior and amplify patterns the general model doesn't magnify. If your bank card score runs 30 points below your FICO 8, the interest rate difference on a card you carry for 2 years adds several $100s in unnecessary interest. The gap looks small. The compounding doesn't. Each of those systems exists across 3 bureaus. Add them together. That's how you reach 49. You've been watching one score, maybe 2. The lender processing your next mortgage will pull 3, 1 per bureau, and none of them will be the version you've seen. Worth saying directly, 5 of those 49 are available to you. Purchasable, not classified. They're just not in the free apps because those apps exist to be simple, and the loan-specific score that matters for your next application is not a simple product. The number that controls your mortgage rate is a different product entirely. Here's what the gap looks like in dollars. Someone finances $40,000 for a car. Their general FICO 8 reads 720. Payments are clean, utilization controlled, preparation done. The dealership runs FICO Auto Score 8 and sees 661. The reason? A car payment 30 days late 4 years ago. The general model absorbed it. The auto model was specifically built to find it. The rate difference between 720 and 661 on a 60-month $40,000 auto loan is roughly 5 to 6 percentage points. That converts to more than $6,800 in additional interest over the loan term, not from anything on the current loan, from a delinquency on a previous one, caught by a model that existed specifically to catch it. When you visualize this system, one credit file, 49 algorithmic lenses trained on top of it. Each magnifies something different. One was calibrated for mortgage underwriting in 2001, one for auto lending. One sees a single-day snapshot. One is starting to track a 24-month trajectory. The file doesn't change. The lenses produce different conclusions, and the lender selects the lens without explaining the selection. What I'm about to show you is the part most people never find. Don't stop here. This is what changes what you do before the next application. For a conventional mortgage backed by Fannie Mae or Freddie Mac, federal guidelines require lenders to pull 3 specific models. Not FICO 8, not FICO 9, not FICO 10. The required models are FICO 2 from your Experian file, FICO 4 from your TransUnion file, and FICO 5 from your Equifax file. All 3 are pulled. The highest is discarded. The lowest is discarded. The middle score prices your loan. These models were developed between 1999 and 2004. They became the required standard before FICO 8 existed. That federal mandate hasn't changed. The older models read certain behaviors more harshly than the versions most people monitor. Paid collection accounts still carry weight under FICO 2 and FICO 5. Medical debt that FICO 9 treats leniently still registers as a significant negative. Authorized user accounts receive more skepticism. Thin credit files score lower. If you've been building your FICO 8 profile for 2 years based on current model logic, some of that improvement hasn't transferred to the mortgage models at all. You've almost certainly never seen your FICO 2, 4, or 5. Free monitoring tools show VantageScore 3.0, a structurally separate scoring product built by the 3 bureaus in 2006 to compete with FICO. Different company, different formula, different algorithm. The number on Credit Karma has no direct mathematical relationship to what your mortgage lender will pull. Not a close approximation. A different product. The people who built them are not the same company, and the predictions they're optimizing for are calibrated differently. Your bank app might show a FICO 8, more useful than VantageScore for general preparation. Still not the mortgage model. Here's the number that earns a second listen. Data from MyFICO based on 2025 rates shows that on a $250,000 30-year fixed mortgage, the total interest difference between the top and bottom FICO score tiers is $69 and $80, $60,980. Not between having no credit and perfect credit. Between scoring tiers on the same product at the same lender. Bring that to the 46-point gap. FICO 8 at 760, FICO 4 at 714. 2 different mortgage pricing tiers. On a $300,000 loan, that tier difference runs between $12,000 and $18,000 in additional interest over 30 years. On a gap the borrower didn't know existed because they were checking the wrong version. Now, the second thing promised. FICO 10T. Older models see a snapshot. Your balance on the last day of the reporting period. Pay to zero on day 30 after carrying a high balance all month, and the old model records a zero balance, low-risk borrower. FICO 10T looks back 24 consecutive months. It doesn't see a balance. It sees a trajectory. Are your balances rising? Are you paying minimums or making aggressive paydowns? The model calculates your velocity of debt, the direction you're moving, not just where you are on any given day. If you carried high balances for 20 of the past 24 months and paid off right before applying, that 20-month pattern registers. The algorithm was designed specifically to detect managed timing. Some lenders have already moved to it. The tactic of timing a payoff directly before an application is no longer a reliable play. FICO 10T also registers debt velocity, rising balances across consecutive months. A trend can't be corrected with a single payoff. The model was built to prevent exactly that. The credit system knows this gap is there. Underwriters are trained on it. Rate sheets are built around these specific models. The information is in lender training documentation and credit bureau technical guides. It just doesn't get passed to the people it applies to at the time when knowing it would change what they did. Let's bring this to the ground level. The borrower never missed a payment, never carried dangerous debt, never had a late payment in years, still lost more than $14,000. Because the score that mattered was one they'd never seen. The 46-point gap. FICO 8 at 760, FICO 4 at 714. Why? The cause is almost always traceable to a small number of items. An older collection account, paid years ago, still carrying weight under FICO 4 that FICO 8 had largely absorbed. An authorized user account that helped the FICO 8 but read skeptically under the older mortgage model. None of these are catastrophic. None are surprising in retrospect. None of them appeared on the app that showed 7 on 60. The borrower wasn't reckless. The borrower wasn't irresponsible. The borrower was looking at the wrong score. The borrower did everything that's commonly recommended. Payments on time. Utilization controlled. No unnecessary new accounts. The preparation was real. It just wasn't for the test being administered. Here's what compounds the problem. Most credit advice, the articles, the YouTube videos, the tips from banks, is calibrated to FICO 8, the modern model, the accessible one. The advice isn't wrong. FICO 8 preparation genuinely helps with credit cards and personal loan approvals. It just isn't what determines your mortgage rate. And the mortgage is where the differences compound into 5 figures. The mortgage industry uses FICO 2, 4, and 5 because Fannie Mae and Freddie Mac require it. This is documented and published. The score products are for sale on myfico.com. None of this is hidden in the sense of being classified. It's hidden in the sense that nobody hands it to you when you start paying attention to your credit. And the cost shows up across every loan type. The auto loan where Vantage score was in your head instead of the FICO auto score. The credit card denial that had nothing to do with your FICO 8, which was fine, and everything to do with the issuer's bank card score, which flagged a revolving pattern the general model hadn't flagged. The mortgage rate that felt like a fair assessment but was priced on a model you'd never looked at. You have 49 scores. 5 are directly accessible. The ones governing your most expensive financial decisions are in those 5. They've been there for years. Nobody made them the default. That gap between what's available and what you're shown is where the cost lives. The rate you were quoted isn't an arbitrary number. It's the mathematical output of a scoring model you were never told was being used to evaluate you. The dangerous part was never that lenders know this and you don't. Systems built for institutions aren't obligated to educate the people they measure. The dangerous part is that you've been making 30-year financial commitments on the basis of information that was designed to be incomplete for the consumer. Not by accident, by architecture. Now you have the architecture. Here's exactly what to do. In order. Step 1. Stop using Credit Karma, your bank's free score feature, or any platform that shows a single free number as your loan preparation tool. Those platforms show Vantage Score 3.0 or FICO 8. Neither is the mortgage model. Neither is the auto model. Track them for fraud alerts. Don't build a loan strategy around them. You are studying for the wrong test. Step 2. Go to myfico.com 90 days before any major application. Pay for the 3-bureau report. It gives you FICO 2, 4, and 5, the actual required mortgage models, plus FICO 8 and auto scores across all 3 bureaus. You're not buying numbers. You're buying the view the underwriter will have before they have it. Step 3. Find your tier. Mortgage pricing breakpoints are 6 and 20, 640, 6 and 60, 680, 700, 720, 740, and 760. Find the middle score from FICO 2, 4, and 5. Identify which tier it falls in. Identify the tier directly above it. The only gap worth closing before you apply is the one between your current tier and the next one up. Step 4. If your FICO 2, 4, or 5 runs more than 15 points below your FICO 8, the difference usually has a visible source. Pull your reports from annualcreditreport.com, free, 1 per bureau per year. The older models are stricter about collection accounts, authorized user accounts, and high utilization on individual cards. The gap between your new model score and your old model score almost always traces to one or two specific line items that are readable and in some cases addressable before you apply. Step 5. Financing a car. Ask the finance desk which FICO auto score version they use before they run anything. They know the answer. The question takes 30 seconds and changes what you prepare around. Walking in with Credit Karma's number and walking in with your actual FICO auto score 8 are two completely different positions. The system has 49 versions. You need to know which one applies to the decision you're making, and look at that one before anyone else does. What score did you think you had, and what did the lender actually pull when it mattered? Drop the numbers below. I read every one. If this gave you something real you didn't have before, subscribe. There's a lot more of this coming. Next, I'm going into how collection accounts age differently across old and new FICO models, and why most people dispute or remove them at exactly the wrong time. The timing is more counterintuitive than you'd expect. It connects directly to what we just covered. One last thing worth saying clearly: the credit scoring infrastructure is a commercial product. FICO builds models, bureaus maintain the underlying data, lenders subscribe to specific versions. Every party has a legitimate business purpose. The scores predict a default risk with reasonable accuracy. That's what they were built to do. But the design goal was prediction accuracy for the institutions paying for it, not transparency for the people being scored. Those two objectives are not the same, and the system optimizes for the one it was built to serve. Lenders receive detailed model documentation. They know which version they pull and why. You receive a consumer interface built to be simple and retentive. Different objective entirely. What changes for you is the frame. You don't have one credit score. You never did. The 49 versions were always there. 5 that matter for major lending decisions are directly accessible. The specific one that applies to your next application is knowable before you apply, not after the rate is locked in. You don't have one credit score. You never did. The dangerous part isn't that lenders know that. It's that you didn't. Now you do. Drop your take in the comments. Next, collection accounts and old FICO models. Why removing them at the wrong time can hurt more than help. It connects directly to everything we just covered.